my objective was having this be a backdoor into obtaining properties because I wanted to further the landlording. But what I found is the real gold is in working with the homeowners to keep them in their homes with loan modifications that give you a 20 or 30-year cash flow stream.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, you have a birthday coming up, man.
It happens every year, Eric.
So it's 107 this year?
Yeah, make it 108. You know, in this business, listen, I keep my gray hairs inside.
It is quite amazing. There literally is dust on the floor in Steven's house that is younger than him.
You're going to get me into trouble. I attempt to make like I'm doing a good job at cleaning up, and I do. But I got to say, I mean, he does not have a freaking gray hair. Well, but every year I get older, I get wiser, Eric, and learn a little bit more about real estate, or maybe I just understand less, but it's fun anyway.
Well, you know what? And a lot of our guests make us feel like we don't know anything.
Yeah, because we get really smart people, and it's so interesting. You know, everybody wants to talk, and here we get as hosts to listen to some really smart people doing things that you sometimes think, well, why didn't I think of that? Why am I sitting here?
Yeah, no, I mean, we definitely have had some very successful people on the show. Of course, today's no exception. It's a little bit of change of pace here. We're going to talk some mortgages. You know, it's an interesting topic. You know, as people are looking for, you know, better yields, it's a struggle right now with the market the way it is to be out purchasing individual units. It's a struggle, and we're finding this common complaint from everybody. I don't care what asset class you're chasing right now. It's increasingly difficult to find deal flow. You know, we're doing okay on the property management side, Steve. We continue to add deals. There's been a lot of property that turned over. You know, obviously on the property management side, we do all the legwork for folks and then deliver a check to them in their mailbox every month, and you know, work with them on trying to not only help them find deals, but also to help them manage and keep their finances in order and whatnot. So that's been a pretty good business for us. But and frankly, the sales have been pretty good, right? But it is a struggle to get deals done right now.
Well, it's a struggle, and you know, real estate's kind of like a diamond. It has so many different facets, and there's just so many components. And so that's what's interesting about today's show, is that we're talking to someone who's just found a way to. There's another facet that we don't pay too much attention to, but it's important nevertheless.
Yeah, no doubt. Wanted to just take time to read a quick review as we discuss every show. If you've not done so, please go to the Apple Podcast Store, the Apple iTunes Store, and give us a review. It definitely is helpful for us, our guests. It is challenge. We have to go through literally dozens of people to every time we get a guest. We want to try to find the right people, and they're busy, and they want to make sure they're allocating their time properly, and it's to an effort that is going to be of some value to them. So if you've not done so already, really would appreciate you going to the iTunes Store, going to our website, or whatever it might be, and leave a review. It does help with our guests, and we'll definitely take the time to read it if you give us a review. So great show. It says the review from YSL786. Love the content and the sense of humor. That's much appreciated that you took the time to do that, YSFL.
I think that must be Yves Saint Laurent. You know, it's nice to know our little show reaches such great levels.
We do have a lot of interesting listeners. Sometimes they pop up and will make comments to us or send us emails. So appreciate the review. And if you've not done so already, please do go and leave us a review. It does help with our programming efforts. Steven, anything else before we get rolling with our guest?
Now let's move right into it. Today we have with us Martin Saenz. Martin is a managing partner of Bequest Funds. Martin has written 3 books on the mortgage industry. He co-founded Bequest Funds with the dual purpose of helping investors grow their wealth and helping mortgage borrowers stay in their homes. Martin is a seasoned real estate investor with over 15 years of experience, and he brings a high level of experience and strategy to the Bequest model. Martin has a BA in philosophy from UT San Antonio, an MBA from Drexel University, and an MS in project management from George Washington University. Martin, welcome to the Invest Florida show.
Thanks for having me on.
Martin, really appreciate
the
time that you're investing with us today. Why don't you give us a brief overview of how you got started in real estate to begin with?
Sure. So, it started with myself reading a book that you may or may not have heard of, Rich Dad, Poor Dad.
Oh, no one's heard of that one.
Can you tell me a little bit about that book?
It's almost like the Bible for real estate investing.
Yeah.
And so in 2003 and 2004, my wife and I, we just started, we realized corporate America wasn't for us. And so we wanted to venture out on our own. And so we picked up every real estate investing book, starting with Rich Dad, Poor Dad. We went to a bunch of real estate seminars. And what we learned is that we really needed to have a business that was producing monthly income that we could roll into real estate properties to have something sustainable for ourselves. That was kind of our vision for moving into the space. So we founded a government contracting company, and after bleeding money for 3 years and getting that off the ground, we started receiving. We started doing well with contracts, and we bought our first property, a commercial building, in 2009, and we moved our company into that building, and then we bought the neighboring building a month later. So that was kind of the start of our journey.
Now, I should add that you're in Sarasota, right?
I'm in Sarasota currently. At that time, we were in the Washington, D.C. area.
Okay.
So that was where we kind of started building our real estate portfolio there of buy and hold properties.
Gotcha. So you migrated from D.C. to Sarasota. When was that? That
was in December of 2020.
Okay.
So we've been here literally 1 year. We moved our whole company down. We relocated the staff, and we got a Class A lease space in downtown Sarasota.
What was your, we're always talking to people about moving businesses and getting inquiries to move businesses to Florida. What was your motivation to move to Florida?
Yeah, so it was something that my wife and I wanted to do for a long time, a number of years, be down in the Florida market. However, with our tie-ins with the federal contracting market, it was advantageous to be in the DC area. But since we sold that company in 2013, we did get to a point where we just realized, hey, COVID's happening. We're making more money than we've made, ever. So we need the tax savings. We want to be down in Florida, so let's make a run. And my partner was operating out of Denver at the time. So logistically, we needed to really be together to kind of scale the business. So he moved from Denver and we moved from DC along with the staff down to Florida and just kind of put our stake in the ground here.
And Sarasota is a beautiful community. How are you finding the real estate market in your brief period you've been there?
Yeah, so it's been taxing finding a place to live. We've rented for a year, and we actually just got a home under contract that we feel we're not getting gouged on. So I consider that a miracle for a primary residence in Sarasota. But as far as venturing into real estate outside, we're just now looking at the Florida market to look at purchasing large commercial / warehouse spaces all throughout Florida, because we're actually going to start launching an effort here in the very near future.
Interesting. Is that going to be a fund also, or is that going to be your personal money or syndicated money?
So we're going to start with Yeah, we'll start with personal money as we always do. I'm selling off properties in the DC area now that we still own, and so we'll start it with a personal effort, and then perhaps roll it into a fund that's a mixed fund between real estate and mortgage notes.
So tell us how you migrated from real estate investing into working with notes and getting returns for investors on notes.
Yeah, exactly. That was the question I was going to ask, and why, the equity, the debt versus the equity side. Like, what were you seeing there that you said this is a better opportunity, or our opportunity that would fit us better?
Yeah, I think so. I ran into a note investor at a local real estate club, and he was an educator, and I took a few of his workshops, and I read every book that I could find on it. And what I found fascinating was that I can obtain long-term cash flow streams without having any of the burdens of property ownership. And so, whereas you're being the bank. And so that really just kind of fascinated me. And if you look at kind of a map of various activities where real estate is involved, the bank's always kind of in the center of it, whether there's private money lending or wholesaling or flipping or landlording or what have you. So I felt like that was a good place to position myself.
So talk about the types of mortgages that you're buying them for your fund now and for yourself personally. What types of mortgages are you pursuing?
So these are all bank originated residential owner occupied mortgages, and we buy them. We have a hedge fund that buys them in a distressed state from the secondary mortgage market, and we also have an income fund we have a group of accredited investors that invest with us, and we only buy performing seasoned residential mortgages in the income fund. So it's really two types of mortgages we buy, but both are residential owner occupied mortgages because we like the equity coverage and we like the emotional equity that's tied behind it.
Mm-hmm. And if one of the things always that has been interesting about notes is there's always the possibility that you're protected because you got the lien on the property, and if somebody doesn't perform, you have additional upside. Have you been involved in those kinds of situations?
Yes. So we've been buying mortgage loans, for the past 9 years. I've had the hedge fund open. So it's we've seen every type of scenario. What's interesting is that when I first got into the space, my objective was having this be a backdoor into obtaining properties because I wanted to further the landlording. But what I found is the real gold is in working with the homeowners to keep them in their homes with loan modifications that give you a 20 or 30-year cash flow stream. And to do that, to work with creating those loan modifications as much as possible. So that really became my passion with the note space.
Are your funds leveraged, or are you 100% equity on the fund side?
Yeah, so the fund has no leverage, and we launched the income fund. It was February of 2020, so we're coming up in about 2 years soon. And there's 10 million assets under management there, and there's no leverage to that fund.
And so, what kind of yield do investors get from their notes?
Yeah, so it's actually a fixed income fund, so they can come in and receive an 8% annual pref paid monthly with a 1-year commitment, or they can receive a 9-year annual pref paid monthly with a 4-year commitment. So it's a very what we consider a very low risk, high yield fund because the portfolio itself sits at a 63% investment to value ratio.
Yeah, that's very good.
Rather.
So how are you finding these deals?
Yeah, so from other hedge funds in the secondary market. So if you take the progression of things, whereas you have someone that wants to be a homeowner, they go in, they get a mortgage from a bank. and it goes through underwriting. They go to the closing table, they sign a promissory note to promise to pay back the money given certain set of terms. And then they sign a deed of trust or a mortgage that ties that promise to the property in the form of collateral. So if they refuse to pay or they're unwilling to pay, then the foreclosure process starts and the property is lost. Now, what happens is a percentage of these bank-originated mortgages go into default because something happens in the homeowner's life. And over time, some of these banks bundle these into tranches and sell them into the secondary mortgage market space at 20, 30, 40 cents on the dollar to hedge funds like ours. And the hedge fund, we have a team of asset managers that work closely with the homeowners to create a loan modification that they can afford. So given that we purchase these mortgages at a discount, we're able to offer certain concessions, but still hit the numbers we need to hit to operate our business. And that's the win-win. And so over time, the mortgages get re-seasoned because the borrowers are making their payments, 12 months, 24 months, and everything's good. And at that point, our income fund will buy mortgages like those into our fund at a 12 to 13% yield, whereas we're able to comfortably pay out the 9%, 8% annual pref.
So, there's a couple of different ways people can skin this cat. They can just go to you if they don't really want to do the work, and they can get a pretty decent return. And then perhaps they could, if they want to do this on their own and say, well, I really just want to manage this process myself. How would you recommend that they go about doing that?
It really depends on how entrepreneurial they are. I came into this business as an entrepreneur to go and feed my family and grow a business. So, I put my own money at risk before I touched $1 from an investor. My first purchase was $240K worth of for 10 first lien mortgage loans. And so I put my own money out and took my lumps and built my systems and everything else. So if you have the time and effort, then, you can pick up some good books. I've written 3 on how to set up a note business, and they're on Amazon, and they can be really helpful. Just know that there's a lot more pitfalls to this industry on the note side than there is on the real estate side. I know there's a ton on the real estate side. I get it, but I'm speaking in terms of compliance from a federal, state, and local regulatory perspective. There's a number of licenses, bonding. There's just a whole host of just compliance, items that one has to check in order to operate a note business. So you have to kind of be prepared for that if you want to do it yourself.
Martin, could you just mention the names of your 3 books in case any of our listeners would like to read them?
Sure. Note Investing Made Easier, Real Estate Note Investing Mentorship, Note Investing Fundamentals are the 3 note-related books. And Note Investing Made Easier was really put me on the map. I was kind of operating in the shadows, if you will, for a number of years. And I received a spiritual calling while I was in church, of all places. And imagine that. And it just, I felt the calling to share what I knew. And so that's what I did. I wrote a book over the course of 4 months, self-published it, and it went like wildfire, and people just have been reaching out to me ever since, which has been a real blessing.
So, Martin, have you ever expanded that concept into commercial loans, or do you just stay with residential?
So what's interesting is that a lot of the principles from a deal flow generation, from a due diligence perspective, as well as asset management, do carry over into the commercial space. So, but with that said, it it would be a whole other group of hedge funds that we would have to spend time cultivating relationships with, and we would have to tweak some of our systems. We just haven't gotten there. We do some business notes. We do buy some business notes. So we have ventured into the commercial area. But as far as commercial real estate, we haven't gone down that road yet. We've just been really focused on our lane, which is residential mortgages.
Gotcha. So you mentioned the regulatory issues and the hurdles you have to overcome. I'm sure the Consumer Financial Protection Board, which is a relatively new agency, has had some impact, and you're having to maintain compliance with all that. Are you relying on your internal employees to handle compliance, or are you using outsourced third-party compliance firms?
All of the above. So we have a compliance individual here in house. We also have general counsel. We've hired a compliance law firm that helps give you a compliance outlook throughout the United States based on your note portfolio. We have, we've worked with MLS to get our asset managers licensed. So we've taken several different approaches. Plus, we work with licensed servicers too that help keep us in compliance.
Talk to us a little bit about the debt market. I mean, where are we right now? Are you finding it a little bit tougher slog, or is it starting to? I mean, because you guys are going to be the canaries in the coal mine for where the economy is heading. So I'm curious to hear your perspective on the debt market and what you're seeing right now. Is there any signs of weakness out there that we should be concerned about if we're owning real estate or the economy, based from the economy?
So I think a real powerful indicator is the mortgage delinquency rate, and it's been just trending lower month after month. Last reported, I think, was in August, and it was at 2.5% of U.S. mortgages, residential mortgages are in some delinquent state. So, as that number, keeps decreasing, that shows some positivity. That doesn't help with pricing, with where pricing's at. I can tell you that pricing within the mortgage note space has drastically increased over the past few years. So it's what it's done is it's squeezed out a lot of mom and pop players. And I think that's the same on the real estate side too, but as far as deal flow between hedge funds, like the ones we operate, we've seen steady deal flow. We've been trading every quarter on pools of mortgages, so we haven't had a slowdown. But downstream with the mom and pops, there's definitely been a tightening up. There's no inventory for the most part.
That's across the market. I mean, it doesn't matter whether you're in the stock market or you're buying single family homes or multifamily or mortgages for that matter. Everybody's chasing yield. Everybody's chasing return. And there's too many dollars chasing too few deals. And we're just seeing, continued cap rate compression on the real estate side. And you're telling me it's also difficult on the mortgage side.
It's everywhere. I mean, there's just no inventory, no matter what you're doing. If you go to a restaurant, there's no service. It's just things changed a little.
It's concerning to me when you see, compression so much on these returns. Usually that's not a good sign. But I don't know. What are your thoughts, Martin?
Yeah, I think something has to give. If you look at the map of the U.S. and you look at state by state in terms of average wages versus the increase in rents and mortgage payments, you'll see a big discrepancy. Wages are stagnant, and rents and mortgage payments keep going up. So at some point, something has to give. People aren't going to be able to pay, or on the business side, investors are going to sideline their capital till something happens.
Yeah, it's been interesting to see. I mean, in your business world, I can imagine that some of the delinquencies that you come across now, where you're able to get bargains were at higher interest rates, and so you're able to go to them and offer them a refinancing deal and position them better. But as interest rates have kept dropping, like new delinquencies down the pike will be at much lower interest rates. Might be harder to offer them a deal that's appealing to them for refinance.
Yeah, the interest rates, capital is too cheap. So what that means for us on the note space is actually we've been seeing record high payoffs on our mortgage portfolio, which has been very positive, whether it's on the income fund side or the hedge fund side. So if we're buying in at a discount, which we always are, and getting paid off at par, then that's been a win-win. That's been a win for us. And it's a win for the consumer too, because they're able to lower their interest rate and cost, their debt obligation and whatnot, or their debt to income ratio rather.
I know that you're indifferent to where you're buying. I mean, you would buy in Arizona just as you would in Florida or Michigan. But curious what you're seeing right now in Florida. Is there anything that's maybe good signs, negative signs, just interesting factoids that you might see when you're looking at your Florida, purchasing Florida assets? Talking about the mortgage side, of course.
Yeah. So when I wrote Note Investing Made Easier in 2017, I raved about Florida. That was the number one state that I had preferred for buying mortgages. I've had everything was really good in terms of resolutions I was getting, in terms of workouts with the homeowners and timelines. That was my most profitable state. And so I've moved from that thinking as of the past few years, because the legal environment's gotten stricter in Florida, because it is a judicial state. So you do have to go through the court system to file foreclosure and go through the process. And I'm finding that there's been more, we've had a more difficult time going through the court system over the past few years within Florida specifically.
So what's on the horizon? How do you see things changing as, we sit here with tight inventory and...
So it's interesting with the tightness of the inventory, because it stems from payoffs are becoming abundant. So that's decreasing inventory just by virtue of that. Also, hedge funds are not releasing deal flow downstream like they were before, because it's been so profitable with the payoffs and loan modifications that they're keeping product in-house. So all of that's going to result in just less inventory moving upstream. That scenario moving upstream from the mom and pops to mid-tier players. So I assume that in order to survive, one's going to need to look at other asset classes within the note space to move into, such as you have unsecured debt, you have business loans, you have car loans, medical debt, other maybe commercial real estate loans in other areas. So I think more diversification.
Well, Martin, this has been terrific. Why don't you give us an idea? I mean, you're looking for a lot of different things. In terms of our listeners, we have everything from single family home investors to multifamily to industrial buyers to industrial brokers to developers. So we've got the whole realm of potential listeners here. Give us an idea. I mean, you're going to be looking at industrial properties to buy in the future. You're a note buyer, you're an individual investor, maybe in single family homes too. Why don't you tell our listeners kind of what you're looking for, and also if they want to invest in your fund or learn more about your fund, how would they go about doing that?
Okay. And I just got out of a meeting with my partner, and this is so funny, because when I first started buying commercial properties and industrial spaces and buildings, I would seek out sellers. They would allow me to put 10, 15% down, and then they would take back a note over a 15-year term at a 6% interest rate or what have you. And I would find those people all day long. And now we just kind of started researching. You really can't find those deals. anymore. So we may have to go and just kind of look into maybe $3 to $10 million commercial building spaces, and kind of see if that, if we have a little bit more competitiveness or a little less competitiveness at that level. From a real estate perspective, from an income fund perspective, my pitch is this. We pay out 9% annually, and we pay it monthly. So if you're looking for cash flow and you have money sidelined, we are a very safe, conservative fund by which you can still receive something back. It's not going to be as much as you may have made in the glory days, but you know that your money's parked and safe, and it's not in the Wall Street casino, so to speak.
Awesome. Stephen, anything else before we let Martin go?
No, Martin. So if you can just tell us or our listeners how they can reach you if they want to learn more and and maybe someone will be interested to do a deal with you.
Yeah, whether it be a deal on the industrial or a deal with the fund.
I'm game either way. Or if you just have a question for me, note related or what, if you're just curious about something, reach out. Martin at BQFUNDS.com. It's Martin at BQFunds.com.
Awesome. Martin, really appreciate your time that you invested with us today, and looking forward to hearing you as you go along with not only your fund, but your foray into industrial investing.
Yes, sir. Thank you. Thanks for having me on, guys.
Great talking to you.
And that was Martin Saenz talking secondary mortgages. Stephen, interesting. We haven't had a guy like that on before. What were your thoughts?
So he raised one point that we all know, but somehow I never really think about. But at the center, sitting right front and center of every transaction is the lender. So Martin's figured out a way to sit right in the center and help people stay. It's a win-win. People can stay in their homes, and he gets the yield that he needs for investors.
Yeah, the banks are at the wit's end of somebody who might be struggling, and they don't know how to. They're all thumbs trying to figure out how to make it work, and then you get a human-to-human contact that can sort of help work things out. And that's his model. It's that human-to-human contact to try to make a deal that's going to work for the people that own the home and are maybe struggling to make payments, and also he's buying those notes at a discount, so he's able to earn a significantly higher return than the bank was earning before. So I guess the only loser really is the bank, but the bank's not a loser either, Stephen, right? They couldn't figure it out for themselves. So this, removed themselves of a troubled asset.
What's a classic example of where individual entrepreneurs are able to do a deal where institutions can't?
Yeah, they're much more nimble. Stephen, Martin was a terrific guest. It was interesting to hear his perspective. Where can we get other interesting guests?
The one place to go is to our website, www.investfloridashow.com, where you can go back and look at all the archives of past guests, but also stay current. Get the app and listen while you're mobile.
Guys, as always, we appreciate the time that you invest with us each and every episode. And until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.